Hello everyone, welcome back. Today we're gonna look deeper into IAS 16 property, plant and equipment, and I want to focus on the third part of the costs that are included in the initial measurement, which is the initial estimate of the cost of dismantling and decommissioning. According to IAS 37, because when it comes to recognizing those costs, we're going to refer to IAS 37. So according to IAS 37, the liability must be recognized for the best estimate of the future obligation associated with the asset. So oil and gas companies, mining companies, chemical companies, they must estimate the cost that's gonna be at the end of the exploitation of a site, of an asset, to bring back the site to its initial condition. So there's a cost that has to be estimated. So your operations team, your finance team has to come together and estimate a cost for those obligations. Then the future obligation must be discounted at an appropriate rate of interest that reflects the risk of the obligation. So again, the finance team, they're going to look at other assets or other operations within the company and that have a similar risk, and they're going to try to match the discount rate of those assets. They might look elsewhere in the industry, but they want to come up with a discount rate that's realistic and reflects the risk. And then finally, the present value of the decommissioning obligation must be added to the cost of the asset. Then we add the present value to the cost of the asset at the initial measurement. Okay. And then as far as the subsequent entries for the cost of decommissioning, the first part is pretty straightforward. You got to depreciate the asset over the useful life, but make sure that you include the present value of the decommissioning cost. Okay, so those costs have to be included. The second part, a little bit more difficult to visualize, and that's an interest expense charge that's being accrued each year, which represent the increase in the obligation to the passage of time. So you got to build the amount of the present value up to the amount estimated. Okay, so as you're building that up, you got to recognize those charges as interest expense. So that's how we do it when we're recording in the journal. So let's look at a quick problem here. For those that look at prior videos, you're going to remember Fraser Mining. So here it says that Fraser Mining will begin operating a new mine on January 1st, 20X5. It says that so far the costs attributable to the mine are $32 million. Okay. Then, according to FMI's geologist, the mine should be in operation for 25 years. Well, that gives us a useful life. The commissioning costs at the end of the mine's useful life are estimated to be $3.5 million. So, like I said, the finance team, the operations team, they come together. They estimate that in 25 years there's no more resources. And at the time, in 25 years, as far as remediating the site, there's a charge of $3.5 million. Also, when FMI closes the mine, then obviously we're talking about the cost of the commissioning. Lastly, there, according to FMI, the discount rate for this type of obligation is 6%. Okay, and depreciation is taken on a straight line basis with no residual value. So we're asking three things there. Number one, prepare the journal entry for the initial cost of the mine. Prepare the journal entries to be recorded subsequently, so at December 31st, X5 and X6. And then last there, it says, supposing that in 25 years, FMI pays $4.25 million, not $3.5 million, to remediate the site. Prepare the journal entry required at this time. Okay, so let's jump into Excel and let's try to make sense of this problem here. So required number one, part A, we're being asked to prepare the journal entry for the initial cost of the mine. Here, let's pretend that the mine is being recognized in the books at January 1st, 20X5. Okay, so we know that there's already 32 millions there that are going to need to be recognized, plus the present value of the decommissioning cost. So let's look at the present value of the decommissioning cost. So we're going to need to use the PV function in Excel, and the PV function requires that n requires a rate, requires PV, payment, and future value. Those are our typical input there for anything to do with finding the present value, finding payments, finding a rate. So those are usually the 5 inputs that we need. So in this case here, I need to find out the present value. So I'm going to isolate this one at the bottom here. So we know the number of periods, which is 25. We know the rate, 6%. Okay. We don't know the present value. That's what we're looking for. Payments. There's no payments here, so 0. Okay. And then finally, we know the future value, which is estimated at 3.5 million. One more 0. Okay, so now we're looking at the present value. And at any time we're looking at the present value, we need a negative sign. Okay, so equal minus PV function. Okay, and now I can see my inputs there. I need the rate, I need the number of periods, payments 0, and future value 3.5 million. So here is the present value of my decommissioning obligation, 815495. So now I can proceed with that entry there on January 1st. Okay, so Jan 1st 2000x5. Okay, so here's the entry. So we know we're gonna call that the mine asset. We're gonna mine asset, and we're gonna recognize that at 32,815,495. So that's what goes in the book. Okay, then different accounts could be used here, but let's pretend everything goes into account payables. Okay, so accounts payable, we got 32 million. Let's pretend everything goes into accountables. I'm sure there would be mortgages, there would be loans, there would be all type of accounts being used there for getting that mine going. And then lastly there, now we got a decommissioning obligation. And I can borrow it from up here of, so that's the initial entry. Okay, so now let's move down and let's look at B. Okay, so B here we're asked for subsequent entries. Okay, so again, if you remember in prior videos there, I really like using tables, and I'm gonna use those tables again for this part of the problem. So we're looking now at the straight line methods. So what's important here for the straight line method is we need a cost. Okay, so we know that cost. It's right here. Okay, and we use 32,815,495 because remember we're going to include the PV in there. Okay, so everything goes in, and that's the cost is going to be depreciated. We got the useful life. I'm going to use just the initials here, and that's 25 years. And as far as the residual value, there's none. Okay, so those are the 3 inputs that I need. So what I want to get to is I want to get to my depreciation expense. Okay, and that depreciation expense, according to the formula here, equal the cost minus the residual value, and then divided by the useful life. Okay, so I gotta know that formula by heart. That's a key formula. Okay, so maybe here again I'm gonna make this obvious. Those are key numbers here. And then now I want to shift to my table. Like I said, I really like using tables. So I'm just gonna shift to a table here, and when it comes to the straight line method, there's gonna be the period, there's gonna be the depreciation expense, right? There's gonna, oh, little typo here. There's gonna be the accumulated depreciation, and there's gonna be the net book value or the balance there. Okay, so those are the 4 columns that I need for the straight line methods. And then I'm gonna start building my table. I gotta go all the way down to 25. Okay, 25 years. My depreciation expense, because it's a straight line method, it's a consistent number. So I'm gonna borrow it and I'm gonna lock it. Accumulated depreciation, I'm gonna use the cell above, that's empty for now, and then plus the depreciation expense for each year, okay? And then the net book value, we know that figure right here, okay? And every year the net book value is gonna be decreased by the accumulated depreciation. So I'm gonna lock again the initial book value. Okay, I'm gonna lock that cell and then minus the accumulated depreciation. So now I got everything set up and I can drag everything down. It should take me to 0. Perfect. So this is key. I know my residual value is 0 at 25 years and my depreciation expense is consistent. Okay, so that's the one part of what I need to do. So every year there's going to be a depreciation entry. And then what I need to do as well now is I got to take care of that interest charge. Okay, if you remember, there's an interest charge that we need to accrue so we can build up the present value to its future value. Okay, so again, I'm going to use a table here, and the input's going to be similar, so I got a period again. Okay, I got the interest expense. Make this smaller, and then I got a balance. So only 3 columns for this one. Okay, so I'm gonna borrow what's over there, make it simple. Perfect. So now I got my table set up, and what's the balance here? The balance is the present value, which I will borrow from up here. And now every year I got to build that amount up. Okay, so we know it's 6%. So again, here I'm gonna put that 6% here. So it's obvious, it's available to me. Perfect. So what is the charge for year 1? So now, okay, equal the balance times 6% charge. Okay, and I'm going to log that cell. So in the first year, that interest expense charge is 48,930. Okay, and then my balance there, I want to add that charge. Okay, because I'm going to build up to 3.5 million. So equal, again, I'm going to borrow from the cell above plus the interest charge. Okay, perfect. So now everything should be in place for me to just drag down. So what I'm going to do is I'm going to grab both cells and I'm going to drag them down. And sure enough, the bottom number here is 3.5 million. Okay, so every year, obviously, because I'm building up, the amount of interest expense that's going to be charged goes up. Okay, and by year 25, that amount is 198,000. Okay, so now I got my 2 tables. I'm going to move down and proceed with those entries. Oh, excuse me. So in X5, okay, so 2000 and X5, so December 31st, well, we're going to depreciate over the full year. So we're going to depreciation expense charge. And we're going to have an accumulated depreciation charge as well. Okay, and then these amounts here will be, I can just borrow them from my table. So for the first year, obviously it's going to be the same, and then this goes Boom, perfect. Okay, so that's what goes for the first year. For this, as far as the interest charge, now the table really comes handy. So my interest charge, so I'm going to interest expense. And then I got a decommissioning obligation that I got to build up. And what's being charged to it, again, this is very key here. I got to use my table. Is right here in year one, 48,000, almost 49. And same thing there, I can just borrow from the table. In year two, so 2006, at December 31st, again, it's a full year of depreciation, it's a full year of interest expense. So I'm just going to borrow those from up here, make my life a little bit easier. So now, because we're using the straight line method, they're always the same, but I'm still going to borrow them from my table. So year two, and the accumulated depreciation is being charged stays the same. Okay. As far as my interest expense, okay, so again, I'm going to borrow from above, make my life a little bit easier. Perfect. Now, again, that's where my table comes really handy. In year two here, we got 51,000, so I'm going to come back, grab the 51,000, and then same thing there, 51,000 that goes into my decommissioning obligation to build up that amount. Okay, so those are the entries that I need. Okay, subsequent entries that I need. And then required C, let's go back to refresh our memory here. So suppose in 25 years, FMI pays 4.25 million instead of the 3.5 million to remediate the site. So it doesn't take a rocket scientist to understand that there is a loss there probably. It's costing us more than what we thought it would. So we got to record a loss there. So what I got to do here, so in C, okay, what's going to be part of my entry? So I'm going to debit the decommissioning obligation. Okay, so that's done. So I got to, excuse me, owning obligation. So I got to reverse that. Okay, so I can always go back to my table here. Why not? And grab that 3.5 million. So that's one part of the entry. Then there's another entry that I know for sure that's happening, and it's the cash that's going out, right? So I'm going to credit cash, okay, and what's going out is 4.25 million. Boom. Okay, and now there's a gap obviously, and that's my loss. Anytime I got a loss, I got a debit. Lost on decommissioning obligation, and that's gonna be the difference between the two. It's 150,000, so that's the loss here. So that's the entry there that I would record there at that time in 25 years to account for the additional cost over the 3.5 million. So hopefully again the breakdown helps. Hopefully again I hope that the tables help. I think that using tables really is a good tool at the start. Just helps visualizing the way the entries work in the book, especially when it comes to interest expense. It's a great tool to visualize how we'll make our way up for 815 to 3.5 million. So anyways, I hope you're taking a few things from this video and applying it to your courses, and we'll talk to you later.